For decades, silver has sat at the edge of the financial system, officially categorized as a commodity, but quietly treated as a monetary instrument by those closest to the plumbing of global markets. And that ambiguity is where the current risk begins. At the institutional level, large banks don't engage silver as a simple metal trade. They manage it as a balance sheet exposure intertwined with derivatives, hedges, and counterparties. And recent market behavior suggests one of those exposures has grown far larger than the public narrative implies. Behind closed doors, risk isn't discussed in headlines or price charts, but in stress scenarios and liquidity thresholds. And when analysts quietly point to JPMorgan's silver positioning as a potential $20 billion problem, they aren't describing a single bet, but a layered structure that only works under very specific conditions. Historically, silver markets tolerate imbalance for long stretches because physical delivery is slow, opaque, and easily deferred. But when paper claims multiply faster than available supply, the system relies on confidence rather than metal, and confidence has a way of evaporating without warning. In recent years, available data suggests the disconnect between futures volume and physical inventories has widened rather than narrowed, not enough to trigger alarms publicly, but enough to force internal recalculations that rarely stay contained forever. What makes this moment different isn't volatility or speculation, it's the convergence of tightening liquidity, shifting interest rate regimes, and political pressure on large financial institutions to reduce hidden risk, pressures that don't move prices immediately, but reshape incentives quietly. And as those incentives change, the question stops being whether silver can spike or crash, and becomes whether the structures built to control it can hold under stress, a question the market hasn't had to answer yet. Historically, JPMorgan's role in silver has been defined less by directional bets and more by market-making dominance. But dominance creates obligations, and obligations become liabilities when the environment shifts. For years, the bank accumulated influence through futures positions, structured products, and custodial relationships that allowed it to intermediate both sides of the market, a setup that works smoothly until counterparties start behaving defensively rather than opportunistically. Market behavior implies that some participants are no longer rolling positions automatically, choosing instead to shorten duration or demand higher quality collateral. Small adjustments that barely register publicly, but force internal desks to reassess exposure paths. Within large institutions, risk models assume liquidity based on historical norms, and silver's history is deceptive because periods of calm are often followed by sharp, localized breakdowns that don't resemble past episodes closely enough to be predicted cleanly. Reports indicate that as interest rates rose and funding costs followed, the economics of carrying large synthetic silver positions deteriorated, turning what was once a low-friction trade into something that required constant balance sheet justification. What complicates this further is the distinction between paper settlement and physical delivery, because while most contracts never request metal, the system depends on the assumption that they could, an assumption that only matters when it's tested. If even a small fraction of participants begin treating silver as something to hold rather than trade, the margin for error narrows quickly, and that's when large intermediaries discover how much of their control was conditional. And once conditional control starts slipping, the focus shifts from price management to damage containment, a transition that rarely happens smoothly. At the institutional level, the most revealing signals aren't public filings or earnings calls. They're subtle changes in how risk is distributed across desks, and in silver, those shifts have become harder to ignore. Available data suggests that exposure once concentrated in a few dominant players has begun fragmenting, not because risk disappeared, but because it's being redistributed in ways that reduce visibility without reducing total size. Inside large banks, that kind of redistribution usually reflects internal pressure, where senior risk committees push trading units to lower headline exposure while allowing economic exposure to persist through more complex structures. The challenge with silver is that complexity doesn't eliminate physical constraints. It only delays their appearance, and delayed constraints tend to surface under less controlled conditions. Market participants have noticed widening spreads between different silver contracts, a sign that pricing assumptions are no longer uniform, and when uniformity breaks, arbitrage stops working the way models expect. That breakdown matters because arbitrage is what keeps paper and physical markets loosely aligned, and without it, confidence relies on trust in institutions rather than observable flows of metal. As trust becomes the binding force, perception gains weight, and perception can shift faster than inventories, especially when narratives of concentration and imbalance circulate quietly among professionals. Once those narratives take hold, even rational actors begin adjusting defensively, and defensive positioning has a habit of reinforcing the very stress it's trying to avoid. Behind closed doors, the discussion stops being about silver as a market and starts being about silver as a signal, because stress there rarely stays isolated. Within JPMorgan and its peers, silver sits at the intersection of commodities, rates, and credit, meaning strain in one channel can amplify pressure in others without showing up as a single clean loss. When reports indicate a potential multi-billion-dollar risk, that figure doesn't represent a realized whole, but a sensitivity, a measure of how fast conditions could deteriorate if several assumptions fail at once. One of those assumptions is that liquidity remains available even during repositioning, yet recent behavior in funding markets suggests lenders are becoming more selective, especially where collateral valuation depends on stable commodity pricing. Another assumption is that counterparties act independently. But history shows that in moments of uncertainty, behavior converges, and convergence is what overwhelms carefully balanced structures. As internal teams model these scenarios, they don't ask whether the market will panic. They ask how quickly margin requirements could change, because margin moves faster than price and leaves less room to adapt. That's where scale becomes a vulnerability, since large positions can't be adjusted discreetly, and even the act of reducing exposure can move the very market it's meant to protect against. Once that reflexive loop begins, the problem is no longer silver itself, but the feedback between risk management and market perception, a dynamic that has ended quietly for some and catastrophically for others. Historically, when large financial institutions face concentrated risk, the first response isn't liquidation, but time, buying it through extensions, offsets, and negotiated adjustments that keep stress out of public view. In the silver market, time is often purchased by rolling contracts forward, adjusting delivery expectations, or leaning on the assumption that most participants prefer cash settlement, an assumption that holds until incentives change. Recent market behavior implies those incentives may be shifting, as some holders appear less willing to exchange claims for dollars alone, not as a coordinated movement, but as a rational response to uncertainty elsewhere in the system. For a bank like JPMorgan, that shift doesn't require a flood of physical demand to matter. It only requires enough to disrupt forecasting, because risk models depend on probabilities staying within familiar ranges. What makes this especially delicate is that silver inventories, unlike many financial assets, can't be expanded quickly, and the perception of scarcity often matters as much as scarcity itself. As perception changes, hedges that once reduced risk can begin amplifying it, forcing desks to choose between absorbing losses quietly or adjusting positions in ways that signal vulnerability. Signals don't need to be explicit to be noticed, and in tightly watched markets, even minor adjustments are interpreted, often more aggressively than intended. Once interpretation outruns intention, the institution loses control of the narrative, and markets start writing their own version of the risk. At the institutional level, the most dangerous phase isn't the initial imbalance, but the moment when multiple systems begin reacting to each other without a central point of control. For silver, that phase would involve futures markets responding to delivery pressure, funding desks responding to margin changes, and risk committees responding to headline sensitivity, each acting rationally but collectively tightening the same bottleneck. Available data suggests that liquidity buffers across commodity markets are thinner than they appear, largely because they're optimized for efficiency rather than resilience, a design choice that works until it doesn't. Within that framework, JPMorgan's size becomes a double-edged constraint, offering influence in calm conditions, but limiting flexibility when conditions deteriorate and speed becomes essential. Other institutions watch these dynamics closely, not to intervene, but to adjust their own exposure, and those adjustments often happen preemptively, draining liquidity before stress becomes visible. This creates a paradox where the absence of obvious panic masks a growing fragility because everyone is moving carefully at the same time, reducing the system's ability to absorb surprise. Silver's role as both industrial input and financial hedge compounds this, since demand can rise for unrelated reasons, tightening physical availability just as financial pressure builds. When unrelated forces align unintentionally, markets don't get warning shots. They get thresholds, and once crossed, responses tend to be immediate rather than gradual. Behind closed doors, scenarios that once seemed remote start appearing in routine discussions, not because they're expected, but because ignoring them would be negligent. For JPMorgan and institutions like it, the concern isn't a single disorderly day in silver. It's a sequence where small disruptions compound faster than mitigation tools can be deployed. In that sequence, a modest delivery imbalance could trigger margin adjustments, which then affect funding costs, which then force portfolio reallocations elsewhere, spreading pressure beyond the original market. What makes silver uniquely positioned in this chain is its relatively small market size compared to the scale of capital interacting with it, meaning price and availability can move sharply without requiring massive absolute flows. Other banks and funds, aware of this asymmetry, don't need to predict the outcome. They only need to avoid being last, and that mindset quietly accelerates repositioning. Regulatory oversight adds another layer, since large visible losses invite scrutiny even when they're contained, encouraging institutions to manage optics alongside economics. Optics management, however, often conflicts with speed, and delayed action in fast-moving conditions has historically been one of the costliest errors large institutions make. As these pressures accumulate, the window for a controlled resolution narrows, leaving fewer paths that don't involve external intervention or abrupt market repricing. At the institutional level, the final phase of a risk cycle isn't marked by collapse but by decision, the point where maintaining control becomes more expensive than conceding it. For silver, that decision would revolve around whether dominant intermediaries continue absorbing imbalance or allow prices and delivery terms to adjust more freely, even if that adjustment reveals uncomfortable truths. Available data suggests the market is approaching a zone where incremental fixes lose effectiveness, not because tools are exhausted, but because their side effects outweigh their benefits. In that environment, JPMorgan's $20 billion figure functions less as a forecast and more as a boundary, a reminder of how quickly exposure could translate into realized stress under unfavorable conditions. What happens next wouldn't be driven by a single actor or announcement, but by cumulative choices made quietly across desks, funds, and regulators, each prioritizing their own stability. Silver's history shows that when those choices align defensively, the market reprices without negotiation, bypassing gradual transitions. The broader implication isn't limited to one bank or one metal, because silver often acts as a pressure point where systemic assumptions are tested rather than confirmed. And as those assumptions face their next test, the market will reveal whether this was a contained imbalance or an early signal of something far harder to manage. For decades, silver has been treated as manageable precisely because its disruptions rarely look dramatic at first, unfolding instead through balance sheets, risk committees, and settlement mechanics long before they reach public view. If JP Morgan's exposure remains controlled, it won't be because the risk never existed, but because it was absorbed, redistributed, or neutralized in ways that leave little trace outside institutional circles. If it doesn't, the adjustment won't announce itself with warnings or explanations. It will emerge through changes in pricing, availability, and behavior that only make sense in hindsight. What comes next depends less on forecasts and more on thresholds, the points where incentives flip and containment gives way to repricing. Silver sits uncomfortably close to those thresholds now, not as a prediction, but as a condition implied by current market structure. Whether this moment passes quietly or forces broader recognition will be determined by decisions already in motion, many of them irreversible. And by the time the outcome feels obvious, it will no longer be a question of risk, but of response.